Alibaba is up 44% in the past 6 months. It's the biggest position in my portfolio, and in this video, I am going to do an in-depth analysis of the company to determine if this stock is still a buy at the current price. Baba stock has been up recently because of two reasons. Reason number one is that Chinese stocks in general have been soaring due to measures by the Chinese government done in order to boost the economy, which include three things. First, lowering the reserve requirement ratio and interest rates to boost lending. Second, reducing mortgage rates and down payments. And third, new tools to boost the stock market, which include refinancing loans for companies to buy back their shares.
Believe this or not, swap facilities to buy stocks, encouraging buyback of stocks, encouraging buybacks of stocks. Okay, this is China, all right? This is stock buybacks, not only encouraging it, lending you money to do it. And they're giving money like TELF money where you can put money out and you have no losses if you want to do it. You know how that thing works? You have only the money you put up and you don't lose money.
Then, Alibaba made a partnership with NVIDIA to advance in the autonomous driving experience. Alibaba is my biggest position, and I am currently up 42%. In order to see if this stock is still a great buy, let's start by taking a look at the valuation. This is a discounted cash flow and net income model, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. According to my assumptions, which are conservative, the intrinsic value of Alibaba is between $81 per share and $258. Moreover, this also means that if the low assumptions occur, you're going to make a 6% annual return on your money, middle 17%, and high 28.5%. Moreover, they are trading at a forward PE of 12 and price to free cash flow of 14, and therefore we can conclude that the company is still trading cheap. As I said before, my assumptions are reasonable as I have the company growing at 4% annually for the next 7 years on my low assumptions, 7% on my middle, and 10% on my high, averaging a profit margin and free cash flow margin of 12, 17, and 23%. It has been around 15% over the past years, but was much higher before. I also assigned a 15, 17, and 19 PE, and assume they buy back 2% of their shares annually because they have been buying a ton of shares back. By the way, these returns include the dividend, which currently has a 0.9% yield. Keep in mind that this is a company that keeps improving their fundamentals, with revenue growing at an average of 13% over the past 5 years, going from 509 million yuan to 950. And analysts are expecting them to grow around 8% for the next 3 years. Moreover, their free cash flow took a hit in 2022, but has been recovering since then. Lastly, this is a company that has basically no debt, as they have $66 billion in cash and only 33 in debt, which is very little for a company that has a market cap of $240 billion. In conclusion, I believe Alibaba is still trading at a very attractive valuation. They are improving their fundamentals, they have basically no debt, and with China's fears going away, I think this stock still has huge upside. I am personally not adding to my position because it's already my number one position, and I will only add if it drops back to my average. Lastly, remember that this is not financial advice and you should always do your own research. I hope you found this video valuable. Let me know what you think about Baba in the comments, and I'll see you in the next one.